Welcome to this very special edition DCREC Podcast series, sponsored by the Defined Contribution Real Estate Council, an organization passionate about providing American workers a financially secure retirement by investing in commercial real estate. And now, here is today's host, Todd Schnick.
Good morning and welcome back to this special edition DCREC briefing. I am your host, Todd Schnick. Thanks for joining us on today's show. We will be discussing the benefits of REITs. And joining us on today's show, say hello to Kurt Walten. He is the co-treasurer of DCREC. Kurt, welcome to the show.
Thank you, Todd. Good to be here.
Well, it's good to have you. Thanks for carving out some time to join us. I know you are a busy fellow, so I appreciate that. To lead us off, as I said, we're going to talk about REITs, a real estate investment trust. So what exactly is a REIT?
Let me see if I could tackle that. A REIT, or a real estate investment trust, is a company that owns or finances income-producing real estate. And by the way, when I'm talking about REITs today, Todd, I'm talking about stock exchange-listed equity REITs. And these are REITs that are traded on major stock exchanges, such as the New York Stock Exchange. And today, REITs are tied to almost every aspect of the economy, and that's reflected in the fact that REITs own and manage a diverse range of property, and that includes commercial office properties, retail properties, various forms of residences such as apartments, industrial facilities. But there also are REITs that own and manage hotels, healthcare-related properties, timberland, storage facilities, and industrial infrastructure properties. Basically, REITs allow anyone to invest in portfolios of large-scale properties the same way they invest in other industries, but through the purchase of stock.
Interesting. I'm familiar with REITs, but I wasn't thinking about it in the context of hotels and timberland and storage facilities. Fascinating stuff. So walk me through the investment attributes that REITs bring to the table.
Well, the bottom line is an investment in REITs is an investment in real estate. And it's generally accepted among the investment and academic community that real estate is a fundamental asset class. So as a fundamental asset class, REITs bring additional diversification benefits to a long-term investment portfolio, in addition to exposure to equities, bonds, and other assets. And this is based on the attributes of the real estate investment, which is they have a distinct economic cycle relative to equities and bonds due to supply inelasticity, which reduces the correlation of investment returns from real estate with the returns from other assets. They also offer competitive long-term investment returns that potentially provide high and growing income from rents, plus moderate capital appreciation over time. The other attribute is they provide portfolio diversification benefits within equity and bond portfolios. And finally, they provide potential inflation hedging attributes, due in part to the fact that many REIT leases are tied to inflation.
Okay, understood. So thinking about defined contribution plans, how should they offer real estate investment through REITs?
Well, when thinking about defined contribution plans, I think it's important to have the context of what's happened in the defined benefit pension world, because pension plans have invested in real estate, including stock exchange listed REITs, for decades. And while defined contribution programs, or DC plans, such as 401k, 403b, and 457 plans have been slower to include real estate, their adoption of the real estate asset class in recent years has been rapid. And a significant portion of plans have added real estate on a standalone basis within their investment menus, but many more plans have incorporated this asset class within their asset allocation offerings, such as their target date funds or target risk funds. And what we've seen is, based on surveys conducted by investment consultants such as Cowen Associates and management consulting firms such as Casey Quirk, a vast majority of target date funds used by DC plans now feature a REIT allocation. And this exposure is typically provided through investments in exchange-listed equity REITs because they provide daily market pricing, they're low cost, they're liquid, and they have a good long-term record of performance.
Okay. All right. So exactly how much should defined contribution participants invest in REITs?
Well, what we found in general as it relates to the real estate asset class, including REITs, is that investors should have a meaningful allocation to the real estate asset class, or REITs. In fact, a study that Nareit, my organization, has sponsored with the investment consulting firm Wilshire Associates each year since 2012 on the role of REITs and listed real estate equities and target date funds, found that a meaningful allocation to U.S. or global REITs increased the long-term investment performance and diversification benefits of target date portfolios. And the allocation that came out of those studies came between 5% to 18%. That was found to be optimal for investors saving for retirement. And really, that underscores why the establishment of the Defined Contribution Real Estate Council was so important.
All right. Well, Kurt, I appreciate you taking some time to share the benefits of REITs. Before I let you go, how can people learn more about the DCREC? And more importantly, where can they learn more about REITs?
Well, for more information on DCREC, people can go to dcrec.org. And for more information on REITs, they can go to REIT.com.
Got it. So dcrec.org and REIT.com. All right. Well, that's all the time we have for today. On behalf of my guest, Kurt Walten, the co-treasurer of DCREC, I am Todd Schnick. We'll see you next time on the DCREC Briefing.